equities in the past few sessions have come under pressure, largely due to the weaknesses in currencies. Do you expect this weakness to continue in the near term?
Well, I think the overall dollar strength is likely to continue going towards the end of the year. However, I'm more optimistic on the index performance of Asian equities, largely due to two factors. One is that the valuation of equities in Asia continues to be very attractive. And secondly, perhaps more importantly, we've noted that in previous episodes, higher US dollar interest rates are actually positive for Asian equities when interest rates are low. So both of which are supportive of our view that Asian equities should continue to perform well in the second half of this year.
What do you make of the weak China data out over the weekend?
Well, I think, frankly, if you look at the fixed asset investments as well as retail sales numbers, the consumption and investment part of the story is more of the same. Export numbers clearly have decelerated, but I think that's partly to do with the tighter regulation or tighter monitoring of the accuracy of the data rather than a loosening of momentum itself. So in that sense, I think the market's been ignoring the strong export data for the past 3 or 4 months and have assumed that export continues to be lackluster. So in that sense, I think we still maintain a long-term positive view of China for two reasons. First of all, valuation in Chinese equities continue to be very attractive. And secondly, with the market expectations of China continues to correct lower, I think that will be a point where the data will actually meet expectations, and this is where we could see more upside to Chinese equities.
How should investors position given the possibility of further easing from Beijing?
Well, we do like cyclical for the reason that we are expecting growth to moderately accelerate in the second half of this year, especially in areas such as financials, where banks' valuation is incredibly attractive. And I think a lot of the bad news, such as potential deterioration in credit quality, has been priced in. Consumer discretionary and staples, both of which are also looking pretty strong on the back of ongoing income growth in the Chinese economy. Where we are more conservative about is perhaps in the materials and also in the industrial side, where export performance continues to be lackluster, and that will only improve once we start to see demand from the US and Europe, as well as other parts of the world, start to recover.
What do you make of the improving economic data out of Japan?
Well, I think given the recent very sharp correction in the Japanese market, it's not particularly easy to convince investors to jump in right now. But I do agree with you that the improvement in the Japanese data, both in the GDP and current account, and also we're seeing consumer confidence and the land prices start to pick up, all of which are suggesting that the first stage of Abenomics is actually working, is changing market sentiment. Obviously, the market seems disappointed with the growth strategy put forward by Prime Minister Abe, but don't forget, any of these reforms are going to be multi-year rather than multi-weeks or months. So in that sense, I do think that Japan continues to be a constructive story from our perspective in the long run, but obviously the momentum at the moment seems to be on the downside.
How do you position in Japan now?
I think the yen will continue to weaken, especially after the pullback that we've seen in recent days. I do think that investors should continue to gradually edge towards Japanese equities, averaging in, really take advantage of this correction to really buy on dips. And I do think that more foreign investors are likely to go into Japan, given the fact that Japan, despite the rally we've seen in the past 6-9 months, continues to be very under-owned by both foreign investors as well as Japanese investors.